Why do good company stocks crash in light of bad news hitting the market? There's bad news out there. In no time, the company's share price start going down. Why is that so? I'm going to explain to you in very simple language in this video for you to understand all the scenarios that make stock prices to crash in light of bad news. In case you are new here, you are much welcome to my channel. My name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you videos about making money and investing each and every day. In case these are topics which you like, kindly consider subscribing to this channel. Down below is a button called subscribe. Click that button for you to subscribe so that you don't miss out on any of the videos which I'm going to continue uploading regularly. And I will still add it, drop a like on this video. Thank you for subscribing and liking this video. Having said that, the very first thing you need to understand is that the stock market does do pricing for the future, not the present. And I'm saying so because investors typically ask one and a simple question. What is going to be the price of this share or this stock in future, right? What are the fundamentals in the market which are assisting me shape my perspective? So think about it. It is a bunch of investors having different perspectives and then reacting or behaving based on the perspective they are having. So if the stimuli is negative, which is bad news, chances are the prices of that particular stock is going to plummet because the confidence of investors is going to be corroded. And if confidence is corroded, the investor's perspective about a particular stock in the future, they think the pricing for that particular stock is going to dip. And if they think the price of that particular stock is going to dip, of course they start taking mitigating measures as a result, making that stock to plummet or crash. And then the second reason is that market and investors hate uncertainty. It is better an investor knows something has gone south. They are going to adjust their position accordingly and in a finite way. But then again, if there's negative news, for example, a company embroiled in legal suits, okay? A company may be firing their management without clarity on what is going on. That creates uncertainty. And if there's uncertainty, the market and investors react appropriately to that particular uncertainty. They'll rather short their position, okay, and come back when things are clear, because they are better off dealing with a negative situation which they know is finite as opposed to them dealing with an unclear situation. And that is why any negative news which is unclear, it's looking like it's not ending, maybe legal suits, you name it, typically hit stock prices of good companies very bad because the market hates uncertainty. The market prefers to work with very good clarity. Something is good, it's definitely like that. Or something is bad, it's also definitely like that. But if there's confusion, be sure the stock prices of even a good company are going to go down or are going to crash, okay? And then the third reason as to why good company stocks do crash is because expectations matter more than results. Look here, if there is negative news hitting the market, that is going to create negative expectation. And rightfully so, because from all the fronts, right from what the analysts are going to be analyzing and saying out there, basically what rumors are going to be saying, what investors are going to be interpreting by themselves, okay? And that perception is really going to hit the prices of stocks real bad, because negative perception is bound to affect the prices of stocks. And that's so because investors won't really sit there comfortably and be comfortable continuing to hold stocks of a given company if the perception is overwhelmingly negative. And that is why bad news is most likely going to affect even the best of company stocks out there, because any negative news, poor result or performance hits the market, okay? Anything regulatory hits the market, okay? Anything scandalous hits the market. All those are going to create instances of expectations mattering more than results, okay? And then the fourth reason is that fear creates panic selling. Look at this scenario, guys. There is negative news which is stemming from the company's end, okay? Relating to a given company whose stock you hold. That negative news is going to make investors to panic. As a result, a good chunk of investors will be looking to relinquish their positions. Basically, they'll be looking to sell stocks, right? And if very many investors want to sell their stocks at once due to panic, what is bound to happen? That is bound to create something called selling pressure or supplier pressure, which as a result, and even based on simple demand and supply equilibrium, is going to force the price to go down because most people want to sell, very few want to buy in case there's panic in the market. That alone is going to force the prices of the different stocks to go down because of that fall in confidence in the market. That is going to really make a company stock to spiral very big and woe unto a given good company if the negative news is prolonged and it is very impactful. It can even make them lose a good chunk of their market cap in just a short instance, okay? And then the fifth reason as to why stocks also plummet in light of bad news is because institutional investors do move the market. What do I mean by institutional investors do move the market? Think about pension funds, think about mutual funds, think about investment wings of banks, you name it. All these are institutional investors because they do hold and have ability to hold very big or huge proportions of company shares in the market. So if there's negative news which is hitting the market, the very first people who are gonna know are typically institutional investors. Because remember, these people have full-time financial analysts, investment analysts, whose work is to gather and utilize both fundamentals and technical aspects of any given stock to better the position of their employer. So, in case of any negative news or bad news, they are going to act very fast. Now think about a scenario where a chunk of institutional investors are dumping or releasing a good chunk of their shares in the market. That is going to mean there are going to be too many available suppliers willing to sell their stocks which they are holding or shares and few buyers. That is going to mean that that price of that particular stock is going to go down, okay? And if it goes down, more so if majority of these institutional investors are looking to relinquish their position, that is one of the biggest nightmares to a company stock out there. In case you have like 50% of people are holding their stock, not even people, 50% of the volume held in a given market, they want to relinquish or change their position, they want to sell. That is a very bad situation for any company, and that typically stems from bad news, okay? Having said that, there are a few things you need to understand. And the first thing you need to understand is that bad news and share prices plummeting in the stock market doesn't necessarily mean the business is bad. Because remember, the market does pricing for the future. The business has its own ongoing operations, which are real and anchored on the current fundamentals, okay? Just because the stock price of a given company is plummeting, it doesn't mean the business of that company is bad. It could be stemming from a negative perception, right? And remember, perceptions out here do shape how the stock market behaves. The stock market thrives on sellers and buyers disagreeing because that is what creates volatility and it ensures that prices change. So if things are looking like the price is shifting, going down, it doesn't mean a great business is bad. If you did your own analysis of a particular company and you discovered it is a quality company, it has ideal debt ratios, right? That company has a good ROE. That company has a very clear competitive advantage. You don't need to panic and behave like everyone else in the market. And I'm saying so because that stock is bound to recover. And by the way, typically there's crashes of two types of crashes. There is the first kind of crash, which is a broad market crash, which typically happens because of macro factors. Maybe it is something hitting the entire economy, therefore making the stock market to crash. And then we have individual stock or sector crashes too. Also those, for example, hit specific sector. Maybe there is negative news around fuel, it's going to hit energy sector. Or maybe it is specific to a given company. That is negative news, yes. But you as an investor, based on the fundamentals and technical analysis you've done, just because it's negative news, and just because negative news is making stock to plummet, it doesn't mean a great company or a great business has become bad. You continue holding your position based on what your analysis has told you, okay? And then the other thing which you also need to know is that every stock crash is either a warning or an opportunity for you in the market. And I'm saying so because that's why you typically hear out here, some investors typically say they typically buy the dip. And then, due to buying the dip, they do buy low and then sell high. That is a possibility. Most in the broad market, dips, it works very well, right? But then again, you also recognize it could be a negative or a positive signal. That is why, based on every crash happening, it is good for you to also do a quick analysis to understand beyond the negative news or the bad news. Are there other fundamentals which have really been offset extremely? Because if they are, maybe your best position is to also relinquish your position in the market, right? Before you lose extensively. And if there isn't, then maybe it is an opportunity for you to buy the dip, because either way, the market is going to recover and that stock is going to be able to appreciate in share price. Guys, those are the reasons as to why bad news negatively affects stock prices of a good company, and also the two tips you can utilize for you to better your position when it comes to you seeing the stock prices plummet. What do you think about this video? I hope you've gotten a thing or two which can assist you better your investment. Cheers, guys. I look forward to catching up with you in the next video. Bye-bye.